Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, my guest is Robert Ribciuc. Robert is the managing partner at EBITDA Catalyst, which is a boutique advisory firm helping businesses of all size price their goods and services. Primarily, Robert and his team work with consumer goods and services. And prior to starting this firm about 12 years ago, Robert was the head of pricing at Honeywell. He also has a lot of experience behind that. He's worked with a bunch of different private equity firms, helping them with their businesses, their portfolio companies price their product. He's worked at hedge funds. He's got an MBA from the University of Chicago, and he did his undergrad at Harvard. And we had a great discussion today about what businesses need to think about when it comes to pricing their products, both in inflationary times and otherwise. And in addition, how prudent pricing strategy can drastically impact a company's valuation. So if you're somebody who's trying to grow your firm, grow your company, grow the value of your company, pricing is something you absolutely need to look at because it's a powerful lever to pull, which Robert shares with us today. This was one of my favorite conversations we've had on the podcast so far. It's a topic that we haven't talked a whole lot about on the show. When we think of revenue management in a business setting, typically we think of, well, if I want more revenue, I just need to go sell more stuff. Robert thinks of it through a slightly different lens, and it was really refreshing to hear his thoughts. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Robert, thanks for joining me on the podcast. I'm really excited to talk with you today.
Hi, Grant. Good to see you, and thanks for having me.
And I'm going to try to pronounce your last name, Ribciuc. Is that
Wow.
close?
Not just close, perfect. You get a definite 5-star on that.
Your coaching was spot on, and I can't wait. So for our listeners out there, Robert just shared something about LinkedIn with me. Apparently there is a feature now where you can record your own voice pronouncing your name. And so if you're ever on there and looking at somebody's profile, you don't have any idea what the pronunciation looks like, look for a link and you can even add them yourself. It's a very cool feature.
I thought you would take this if you're ever blessed with a name nobody can pronounce. That might save you.
That too. Yeah, that part too. So, Robert, tell us a little bit about yourself and EBITDA Catalyst and what you do every day in your professional life.
Sure. So EBITDA Catalyst is a boutique consulting firm that advises brands, particularly in consumer and software as a service industries, about pricing strategy, revenue management, and an array of subsidiary areas like pricing analytics and pricing execution that combined allow firms to basically leverage their pricing power and ultimately grow their profitability, grow their valuations through intelligent, primarily pricing, but other revenue management techniques as well.
How long have you been running the firm?
So the firm was started about 12 years ago. I had a nonlinear trajectory in terms of specifically what I focused on and converged on pricing as a more consistent focus area about 6 or 7 years ago. And during that interval, also, took interim roles once or twice as sort of global leader of pricing for major corporations and so forth to basically build that experience of doing it as well as consulting on it.
I see. So I am really excited to talk with you today about pricing strategy in general for a couple of different reasons. So number one, this is a show that focuses on helping business owners align their business operations with their personal finances. Oftentimes, the biggest financial transaction that a firm or business owner goes through is the sale of their business as they transition away into something else, whether it be retirement or whatever the transition is. And extracting maximum value is often high up on a list of objectives for someone who's approaching the sale of their business. Revenue, cash flow, those are all hugely important metrics when evaluating what you might get for your business. And pricing your product has a lot to do with that. So could you take us through, how you think about this whole ecosystem in general? And I mentioned, number one, that's one reason one topic I want to hit. Another topic I would love to talk about, a few minutes down the road is the inflationary environment we're in right now and how that impacts all this. So how do you think of pricing strategy in general for any company, consumer brand or not?
Yeah, no, thank you. I think that's a broad question. So let me try to unpack it a little bit. First of all, the impact of pricing on valuation, which I think is what you alluded to in the context of someone potentially selling their business, obviously the matter of how do you optimize valuation comes into the focus for the work we do virtually all the time, right? So many of the clients I work with come through private equity firms. So we actually have very good relationships with several large private equity firms. When they have a portfolio company that may have an opportunity in this area, they bring it to us or we talk about it. And of course, in environments like this, there is an opportunity for nearly every firm out there to do things with pricing, whether it is to combat inflation, whether it is to maybe do a pricing project for the first time because in more stable times they had other priorities. So it's been 5 years since they've looked at their pricing and so on. And so I think there's a direct connection. There's this rule that's widely cited in our specialty, which is that pricing is the highest impact lever on profitability and valuation. And it goes back to a study done by McKinsey a couple of decades ago, where they basically looked at 100 or 1,000 firms. They basically looked at the income statements of all of those firms and modeled what would be the impact of a 1% increase in price as compared to, for example, 1% cut in costs or 1% increase in revenue, et cetera, et cetera. And they found back at the time that a 1% increase in price, depending how you look at it, could have a 9 to 11% impact on your operating profit. So if you assume a consistent multiple for valuation purposes, okay, that would translate into at least a 10% valuation increase. Well, that sounds pretty nice to anybody about to sell their business, right? But it goes better than this because not only are you increasing the denominator, that profit that is multiplied, but oftentimes the multiple itself will have a change as a result of showing better margins, better ability to flex that pricing power. Because it goes back to Warren Buffett. He famously said, and I think the quote is on the front page of my website. It's basically the most important consideration in a business's valuation is its pricing power.
Right. And just to take a quick step back for all our listeners, we're throwing around some acronyms. I've talked about cash flow and EBITDA multiples on the show quite a bit over the years. EBITDA is an acronym for earnings before interest, taxes, depreciation, and amortization. And from an analyst's perspective, or anybody who might be a potential buyer of your business, it's a relatively good proxy for cash flow. And so one really common way that we like to evaluate what a business is worth is as a multiple of that EBITDA, right? And a general range that most businesses will transact for, at least the ones that we see, is somewhere around 5 and 8 times EBITDA. Is that close to the range that you're seeing in your universe, Robert?
Well, so it's really interesting you asked the question because it took some courage to name my business, starting with an accounting term that
I was going to say.
a lot of folks on Main Street may not know right away. But earlier in my career, out of college, I spent some time in investment banking. I later spent some time in a hedge fund, so on the investment sell side, where we dealt with valuing businesses all the time. And you are correct, the multiple to EBITDA valuation technique, right? What multiple should you apply? Then take it times whatever your EBITDA number is, that gives you your enterprise value, was the most common valuation technique in our world. And I'd say the multiples will vary widely by industry as well as by company size. So I think most of the privately owned small to medium sized businesses would fall in the range you just mentioned, like maybe a 5 to 8%. Things change rapidly when you're talking, software businesses tend to care a little less about EBITDA because they're super high margin. And then, of course, as you get to larger publicly traded businesses, you basically get a premium multiple because usually when you have a private business, like a privately held business, like you and I have, there's usually a discount for marketability. So when investment bankers value that business, they will say, well, because it's private, it's harder, there's less liquidity, and so you're going to get the lower multiple. So you can see multiples, all the way up into the, 15s and 18s for, very profitable software publicly traded businesses as well.
Yep. That's the excellent point. In the pond we typically swim in here at my firm, it's on the lower end of that range, 5 to 8. And oftentimes, if we have a new client coming in that's starting to approach this transition and they're wanting to determine what their business is worth, what we're trying to do is evaluate, well, how transferable are your contracts and your employment agreements? What do
Right.
your margins look like relative to industry standards? Those kinds of things to
Right.
give us an idea of where in that range they might fall. And
Right.
then secondarily, well, what might be some weak points that we can shore up and get you closer to the top end of that range, knowing that the more, the higher that we go up in EBITDA, the more multiple we're going to get in general as we hit
Yeah.
different platforms along the
There's
way.
there's no doubt, and I think there's a section on my website about working with advisors, specifically in sell side or due diligence type situations. As you might imagine, this is an area that comes up all the time for private equity firms, right? When they seek to evaluate the target, perhaps negotiate with the target for acquisition, and they obviously benefit having a well-educated view. Okay, this company, is their current state the best they can do pricing wise? Is that lever out there to be pulled right after the acquisition, et cetera, et cetera? So if you're an owner of one of those businesses that is thinking about the transition or selling or just improving the position of your business, you got to have a take on that as well, because your buyer, if they have advisors, is probably thinking about these aspects. And so whether you want to pull that lever and improve that profitability so that your valuation is higher because of that, or for whatever reason, save that argument as part of the negotiation, like, hey, we didn't move our pricing for 5 years, we know there's upside there, et cetera, et cetera. You better arrive prepared, because otherwise the other side is basically going to have a leg up in those conversations.
Yep. Great point.
And I might also say, because you are talking about smaller and medium-sized businesses, this is actually an area of one of my new focus areas. So literally, as we speak, I'm building this boot camp, basically, where I can go and talk to a smaller business that is never going to do the kind of project my whatever typical clients will do, but can talk to them for about a half day or however much it takes precisely to educate them on all these topics, sometimes help them reach that alignment or consensus about actions they need to take internally, sometimes manage the anxiety around inflation and how to respond to that. And so I'm actually very excited because it all started very organically. I was in doing this just as a friends and family kind of exercise with my CPA firm, right? So the folks who do my taxes. And this was, maybe 4 years ago and so on. And we spent some time looking at their business, talking about all the different pricing angles over the course of a long afternoon. And literally in the ensuing years, I've been hearing nearly every time I talk to the founder, who's my CPA, he's like, we've never looked back. It made such a difference to like, you could see the inflection point since we talked to you. And by the way, we're in the process of like doing a second one. Like literally, I have a call with them later this week. And so a while ago, I was talking to them again, and I was like, maybe as part of my mission-driven pricing mindset, a way of investing in the community would be to do this for more small and medium-sized businesses, not necessarily as a killer cash-making operation, but as a way to invest in that kind of education and helping that kind of business as well.
That's awesome and refreshing to hear, because this is something that we hear about driving revenue, and I think what everybody jumps to is I have to sell more stuff or more services.
Correct.
And pricing often kind of gets brushed under the rug because it's uncomfortable to increase prices. It's just scary, right? I mean, how do you handle that? Let's say you go through some process and evaluate there's an opportunity to raise prices to where you're still in a competitive area of the market, but it just drives a lot more revenue. How do you think about that? I mean, it has to be scary for every owner.
Yeah, and I think that's where you definitely see some correlation between the size and sophistication of the business and the size of that fear and anxiety.
Sure.
Because the giant companies out there, and I wrote a white paper about this long before this inflation talk heated up to the level that it is today. Early last year in 2021, it's on my LinkedIn profile. And I basically tried to explain how large companies turn inflation into a profit opportunity because they're ready to pull that pricing lever. They have the capabilities to turn it reasonably fast. And then, of course, when the costs go back down, whether that's commodities or any other input, oftentimes the prices don't go back down, right? So the price stays elevated after some price increases, and costs go back down. That's massive profit capture down the line. Now, smaller businesses, because they're much closer to their to their customers, they usually tend to be, I assume, like your businesses within a community. Everybody kind of knows everybody, and you, as the founder or the decision maker, you are not one of those corporate chieftains who might be many layers removed from the individual consumers and customers who buy your products. In a small business, you are in front of your customers, or you are one person away from hearing about their concerns or displeasure if you move your prices. And so I think a couple of things bear sort of mention when you think about that anxiety and how to deal with it. So first of all, a lot of times implicit in that anxiety is an assumption the business owner makes that, hey, I'm selling the same thing and I'm raising the price. Well, if it's the same thing and the price went up, how is that going to feel fair to my customers, right? But one of the key things we try to explain to owners is that you're not selling the same thing. You are selling the value of that thing, right? And the value of something changes with circumstances, market context, level of competition, and most importantly, in a market like this, with actual availability of supply, right? So if you have a market in which, let's say, there were three competitors providing, let's say you're an Indian restaurant, right? And within 2 miles of your restaurant, there were two others, and that's your core competition, right? And now there's all this supply chain madness that we've been witnessing. And there's also labor supply madness that we've been witnessing. And all of a sudden, one of the other two restaurants, or maybe both, either have trouble sourcing certain ingredients or they have trouble sourcing good help and providing a good experience to their customers. Well, on a relative basis, you still providing that service at the high level, that product with consistent reliability actually has increased in value because it's become more scarce, right? What used to be something that everybody could do, now it's increasingly something that only a few can do. And you have probably invested. The reason you still have your high quality staff around, the reason you can still get your ingredients is that probably at some point in the past, you invested in treating your employees better. You invested in a better supply chain relationship with the provider. And all of those things now are paying off in this environment, right? And so that's kind of like the first place to start, right? Like, is the value actually moving? Because if it is, moving the price all of a sudden feels a lot less scary and more justified, just supply demand.
Sure. That's a very interesting and direct way to put it. I really like that framework. How do costs go into it? If I'm thinking of this in a supply chain format, my inputs become more expensive. I'm often kind of forced to raise my prices to preserve margins.
Yeah. Right. So that was going to be number two, right? So I gave you the number one, which is
You led me in just the right way.
has the value moved around, right? In number two, you kind of run into this. Okay, so let's assume all the competitors are still around, but now, and everybody's still providing the same goods and services, but your costs and most likely all of your competitors' costs have gone up, right? Well, you have a couple of thoughts that you should be thinking about. One is nobody benefits from an industry dying off because you can't pay your people. You have to reach into your own personal bank account to subsidize a money losing business. And so, as a business, you have to find a way to be financially healthy. And if costs have gone up, okay, one way to do that is to consider increasing prices. Another way is potentially, if one of your competitors stops providing the good or service, acquiring market share, quote unquote, making more volume. But relying on that more volume is usually a recipe for frustration and disappointment, right? And so the other thought that should occur to you is this is kind of a game theory situation where everybody's watching everybody else's moves, you and your competitors. And so there's signaling value in one market participant raising their prices that sometimes basically unlocks what everybody else was thinking and waiting to do. And of course, we don't want to get anybody into illegal collusion here where you actually talk to your competitors about doing this together. That is not legal in most sectors of the US economy, right? But if you spontaneously say, I'm doing this, I'm sending a letter to my customers, or I'm even putting, some companies telegraph it long in advance. Large publicly traded companies will even send a letter to their distributors and their retailers and so on. And so this news travels fast, and now your competitors have a license to respond, right? And more often than not, they will have been under the same pressure as you, and they will breathe a sigh of relief that someone took on that anxiety and is doing something to keep the business healthy, right? And, yeah.
Can you think of situations where that backfires? You have a leader out there from a game theory perspective that steps out on a limb, raises prices because they're having all these pressures, and then the competitors say, no, we're just going to use this as an opportunity to grab market share.
Absolutely, and that you're kind of leading me down the the step ladder of my pricing philosophy. So I'm loving this.
I would say that you're leading me down your step ladder of
Well,
pricing philosophy.
okay, it's the one I leading the blind, and so I'm just no. I think it's very interesting because my last talk, uh, I was at the Professional Pricing Society in the spring, and I gave a talk precisely on this topic, which is specifically it was about consumer brands because interacting with consumers is one of the more sensitive areas of our economy. It's 70% of the spend in our economy. And the whole premise of the talk was you can become overly focused on the profit motive and forget that you are in a business that also should have a relationship motive with your customers, and it should have a brand growth over time motive. And so keeping those in balance, in other words, not going all greedy because you can, is very important. And sometimes you will find out that, uh, there's this reflexing, someone else is doing it, fear of missing out, I'm going to raise prices. And a lot of people do it without analysis and thought, without consulting folks like us or our fellow pricers in the industry. And so you end up with a lot of really poorly thought through price increases. So I put in my talk several examples of basically disaster cases, right? And so one of the cases that I had back then was Rivian, right? The big electric truck new startup that was going to change the face of automotive. It was going to be the Tesla of trucks or whatever. And they basically hadn't even sold a truck. Like the trucks were not on the road yet. They had contracts and advance orders from all these customers. And before delivering, let's remember the price is compensation for delivering value. So if you haven't delivered value and you haven't created a track record that your products and services are delivering value, you're on thin ice doing crazy things with your price. Well, they went and announced like a 20% plus increase on some of their trucks on customers that had already basically made down payments and so on and so forth. And it was the picture perfect disaster. The stock went down by 50%. CEO had to get up and walk it back and apologize and so on and so forth. So there's definitely a way to do it way wrong. And there's also a way to do it thoughtlessly where you're kind of just relying on everybody else is doing it. It's a little bit like in your business, right? People investing and just relying on stuff going up all the time, right? And I apologize. There's they're building an LRT station outside where I am, so you're going to hear some pounding in the background. Uh, it's not related to our content.
What is LRT? What is that?
Light rail train. So here in Minneapolis, they're
Oh,
building extensions of the light rail, and I think a lot more public transportation. Green ways of traveling across town.
well, if you ever come to a time when you need to sell your home, you're selling the value of the home. It has proximity to the light rail station. Hopefully that
Absolutely,
helps your case a little bit.
absolutely. Yep, no doubt. Yeah, so I think I mean just to kind of circle back on this whole how do you tackle that anxiety? Honestly, of course, a response I'm reluctant to put in because we're not here making pitches is make sure you know what you're doing, and if you kind of know that you don't, find someone who does and talk to them. Someone like ourselves, someone who's done this for a company in your space, et cetera, et cetera. And that's part of our business, right? We help those who recognize this is not as easy as it seems, but it's also not as hard as it seems, right? And so being paralyzed by fear and not doing it ends up creating many of the examples I see where someone comes and says, well, this is the first time we're thinking about this in 7 years, and it's still the way the founder did it 7 years ago. And that's where you have those opportunities, like I was talking with my CPA firm, where there's a lot of low hanging fruit, right? If someone hasn't done anything in this area in a long time, hasn't received professional advice in this area, there's probably a ton of low-hanging fruit, and I've seen this over and over in ridiculous ROI on investing in pricing.
Yeah. Makes total sense. There's someone in my industry who his name is Carl Richards, and he has a quote. I don't think it's an original quote. I think it comes from maybe Seth Godin or somebody like that.
Mhm.
But the way he puts it is, value in the eyes of your customers is a combination of what you're telling them your product or service will do for them. So your promise of future state discounted by probability that you'll be able to get them there.
I love that. So there's slight variations on the words,
Mm-hmm.
but
I butchered the right.
yeah, but that's absolutely accurate. In particular, I face this in my business, and I'm sure you face it in your business, which is, the value proposition for someone like me working with the client in the area of pricing is usually that, done right, pricing virtually always has opportunities to deliver additional profitability, additional value creation, and so on. And what you see is, particularly when working with larger clients, this is a scalable proposition, right? So if you give me $1 billion of revenue to work on, the same work and strategy and fact finding may generate a lot more dollars than on, $20 million of revenue. And as a result, with larger businesses, sometimes you can say, this can generate 20, 30, $40 million of additional profitability. And of course, viewed in relation to that, whatever we charge is puny and creates this enormous ROI. And, with some degree of humbleness, right? So, you know, I have to accept that clients who haven't worked with us before are also going to have to attach some percentage probability. Okay, this sounds really good. I know you've done it for some other companies, but if it was that easy for me, I probably would have done it myself. And so, there's still that, uh, I got to discount this by some element of uncertainty. And I think if we could go in and tell everybody, um, you know, you're going to get the $40 million check tomorrow if you work with us, and it's 100% certain, we would be able to charge a lot more. And, I think, though, for me, that part is actually an opportunity, right? So when I talk about mission driven pricing, we were just talking a second ago about how large brands shouldn't think just about profit, right? They should think about balancing those relationships, and sometimes it's okay to leave a little bit of money on the table. Like, you could charge more, but you're making that investment in, particularly in situations where maybe the other side is vulnerable consumers who are down in this difficult economic environment. Okay, is that a place to go full strength with your pricing power? And so for me, a lot of times, some clients kind of call me out and they're like, well, you don't practice what you preach. Like, sometimes you tell us to, get the money that's on the table and so forth, but like, these projects produced so much value, and like, if you charged a percentage of this, you would have made, and I live with the philosophy that it's okay. That's why I don't work for a very large consulting firm, because I don't want to be in that maximization mindset all the time where I'm working with someone else's growth targets, financial targets, quarterly targets, and everything I get from one of my clients, I've got to get because I'm working for those targets. I love that freedom of having very happy customers who get a hell of a deal, and they call me out and they say, maybe you could have charged more.
That's one of the beauties of entrepreneurship is you can optimize for anything you want. It doesn't necessarily have to be the bottom line. When you dilute your ownership, you take on a partner, maybe a private equity firm, or you go public. Now all of a sudden you have other investors whose intentions and objectives are probably going to be a lot different than yours. And the common denominator here, in the way that our corporate, legal system is set up, is to maximize profitability at the bottom line, right?
Right.
Because corporate officers have a fiduciary responsibility to their shareholders. But when you're the only shareholder, you can optimize for whatever the hell you want. And it's such a refreshing way to think about it. It doesn't always have to be for the bottom line. If your personal expenses covered, you can optimize for your own time or impact on the community, whatever it is that's important to you.
Yeah, and I think you're spot on, and that is at the heart of at least how I apply the concept of mission-driven pricing to my own world, right? So we have these pillars, whether it is, so I do a fair amount of pro bono work with nonprofits that have, believe it or not, nonprofits also sell products and services, so they do have things to price. And
they just pay their officers more and more and more to even out
well,
profits, right?
some nonprofits have officers that work for below poverty like levels. I'm not worried about those getting some help to be paid because they work for really good causes, and in fact, it's part of the joy of being in that work. Sometimes you see these people that do amazingly needed things in society for causes that aren't getting solved in other ways, and honestly, they're not getting paid anywhere near enough for the value that they produce. And so, helping some of those nonprofits find a way to balance that a little better is very rewarding. But I was just trying to put that in a broader context of having some time to do that and do as much of it as it makes sense for me is a very nice counterweight to potentially, like you said, working in a much larger organization and so forth, where you're always maximizing someone else's return, right? And I'm not saying that, we too have to make a living and we too have to have a return ultimately on our contributions. But whether it's that, whether it's thought leadership, writing, and so on and so forth, uh, I do enjoy the balancing of just being able to do some of that when it's the right time to do it.
Absolutely. Absolutely. So I want to circle back to something you said a few minutes ago, and that's this concept of you're selling the value of what your service, what your good, what you're selling does for your consumer. And part of that value is contextual, meaning it's market based, depends on what's going on out there in the world. How do you evaluate value with that kind of context month to month when inflation is present in our economy right now?
Yeah,
What are you looking at?
no, that's a very very good question, and we are no doubt in a more dynamic environment for that than we've been in a very long time because all the things we talked about earlier, whether it's the cost of your inputs, the cost of your labor, the actual availability of your inputs to even make the product or deliver the service, all of those are shifting at higher velocity than we've seen in the past. And so, what is the counter to that? Okay, well, for larger organizations that have more sophistication in this area, more resources, and so on, there's an area of what we do that's called pricing research. And there are all these methods where you keep in close touch with your customers and potential customers of the market's willingness to pay, right? So you talked about, I think earlier in the podcast, pricing is about willingness to pay, which is ultimately about the perceived customers' perceived value for what they're buying. So what that entails is, first of all, that will be different from person to person, right? So two different consumers can have totally different perceptions for the value of something. It can be different today versus tomorrow. And it can be different when it's delivered by you versus when it's delivered by one of your competitors based on things like brand and loyalty and, it's all those other areas of perception. And so I think in pricing, we do, whether it's consumer research, you know, pricing research with methods like willingness to pay surveys, conjoint analysis, which asks consumers to basically make trade-offs, right? So they have a choice of three products at three price points. They choose which one they like, and then you iterate those choices, varying the features, varying the prices, and then some very clever math behind the scenes effectively finds out, okay, on this panel of 500 consumers that you polled, what is the incremental value they ascribe to, I don't know, the tie being yellow or some other feature. And so there are scientific methods that we can deploy. They all have, various natural limitations. Anything that relies on polling customers is going to have some degree of statistical significance challenges. And then I think a lot of times we also say pricing is not an event, it's a process. It's not like you flip a switch and then it's either heaven or hell, you got it right or wrong, the world is over. On the contrary, you should be flipping small switches all the time and learning and iterating and getting that market feedback from the only method that's actually reliable, which is doing it rather than simulating it, right? And so it's a combination of all of those things. There are a lot of firms out there that provide market research, product research, pricing research, and we got to call on the right method for the right client at the right time.
Sure. Interesting. So that makes a lot of sense. If you're Apple and you're trying to figure out where to price your iPhone 19, $4,000 or $8,000 or whatever, you would probably look at all this data that you have, all the performance of each of the previous models, use that, conduct all these market surveys. Does it work any differently if you're coming up with a brand new service or product for which you do not have any history? Seems like you have a lot of opportunity to get it wrong. Are there any other measures you might incorporate in that when coming up with something from scratch?
Yeah, absolutely. I mean, the topic of monetizing innovation, right? So new product introductions, certainly software and the like, is a pretty large topic in our industry. And I think even there you have subtopics. So sometimes a product is a revolutionary product. There's never been anything like it. It's the first time. And other times it's an evolutionary product. It's much better. It has incremental features, but there was a precedent, right? So in your case, for an iPhone, they would be evolutionary versions of the iPhone as you introduce new ones versus the first new drug that is approved by the FDA to treat some condition that there's no other drug for. Very, very different, right? And, in the first case, you have that advantage, whether it's your product or a competitor's product, that is that precedent that was kind of close and you're improving on. So usually a method can apply there where you know what that previous product was selling for or is currently selling for, and then you apply some of these methods to price the incremental benefits, the incremental value in whatever the new product brings to market. And, because you have that precedent to work from that has a validated market price that you could observe, that tends to be a little easier. The second one is the one that's much harder, and that's where bringing all these tools to bear, usually if it's a revolutionary product, a lot is going to ride on this, right? So this is rarely something that you and I in a small business are bringing to market. It's typically something that someone with a lot of funding, with a lot of investment is bringing to market. And that's where it's actually worth spending the money on the expertise and the tools to do all these focus groups and willingness to pay surveys and conjoint analysis type methods, to literally absorb as much information as you can. When I was in this role, I was leading global pricing at Honeywell, which is, a pretty giant place. And so, of course, we would have new products, and the process to bring the new products to market was so involved with so many stakeholders, and there were different checkpoints along the way that were thinking about all the right things pricing wise, because you don't want to bring a great product to market with a terrible price that's going to make it fail.
Right. Very interesting. So you've been growing EBITDA Catalyst kind of off and on for 12 years, you said. What are your biggest challenges right now, and what do the next few years look like at your firm?
I think one of the big challenges for me is I didn't arrive at this as organically as, like there are some people who've been consultants all their life, or they've been in one industry and they just leave after 15 years in one industry and they become consultants to that sort of narrower space. And I think for me, because I've arrived at this in a more circuitous way, I'm still working to narrow that specialization to the place that strikes the right balance between being interesting and broad enough versus being specialized enough. So that continuing to define that identity is something I'm working on. And then I think that balancing act between not wanting to be in something big enough that is dictating the terms of your life, right? Like working for
Right.
a large company. Well, the flip side of that is being in something that's small enough where you are afraid of not learning enough from enough people on a consistent basis. You have to do more of the aspects of the business yourself or with a small team of people. And so you don't necessarily feel that freedom to study and grow in your narrow field of expertise the same way as someone who might have all that infrastructure behind them of a larger firm and so on. So continuing to balance those things and I think I'm very excited about the small and medium business boot camp and kind of growing the ability to honestly reach into those places where there's less money to be made, but there's more difference to be made, if that makes sense. I'm very excited about that as well.
That's precisely why I like working with people in that demographic as well. Number one, I mean, out of convenience, you have fewer smaller and medium sized organizations with a disparate array of ownership group where you have to go in and present to a whole bunch of people and it takes forever for them to make a decision. You have one owner, so they're a little quicker to make a decision about how to proceed with whatever transaction they're working on. But the impact you have is really dramatic in their lives. And it is so rewarding to just be a cog in the engine and kind of along for that entrepreneur's journey in this business or the next business or whatever it looks like for them. It's just such a rewarding, back to your mission driven setup, a rewarding thing to be a part of in the long term.
Yeah,
I
and
completely understand.
I, I mean, you are hitting exactly you know, you can call them the soft points or the strong points of what I love about what I do. And honestly, me ending up doing a lot more in this pricing specialty started like that. It started with the company, it wasn't small anymore. The founder had grown it quite big, but being able to help them turn it around and see up close the individual lives. There's people who deliver the value, the goods and the services. They do a bang up job, and and yet in many companies that value doesn't get harvested from the marketplace, among other things, because they're not good at pricing, right? And being able to go in, help a place like that turn around from negative EBITDA to double digit EBITDA margins within 12 months, and then walk with the founder on the floor, people you've gotten to know, and just see grown men get promotions they were owed for the past 4 years, but the business didn't have the money to do it. You know, grown people kind of tearing up, and there's something emotional about having that impact. And you're right, it's easier to find that in a place where uh, the distance between the line workers and the decision makers is a little shorter.
Yeah, that's very well put. So what will your boot camps look like? Are we talking like video courses? Are we talking group
I,
in-person
I, I
things?
yeah, I think obviously where it's possible to do it in person, precisely because of the reasons we just touched on, which is at the end of the day, it's a lot about the satisfaction of meeting the real people, if it's in my local community or somewhere where I can travel. Um, there's no substitute for making a difference to real people and making it real in that way. And so if that's an option, that would probably be preferable. I think obviously with the nature of our times and just being able to have a wider reach, I have to have the option of doing it remotely as well. But I think in the immediate term, I'm going to try to do it a few times with local businesses, because the idea of investing in the community as well while doing it is so appealing, and just building that base of feedback, and hopefully a bunch of success stories from that will be very fun.
Well, that sounds wonderful. I'm excited to watch your growth and build out this new service for local people. It sounds wonderful.
And hey, I mean, I would be remiss if I wouldn't offer it to you. If your firm ever needs, a friends and family, quick or not so quick input on how you guys price your services. I know it's a very competitive business and investment management and so on, but I'm happy to be a lifeline if I can, and just pay it forward.
Oh, I appreciate that, Robert. I genuinely appreciate that. Well, what have we missed? I've really enjoyed this discussion. This is not something that we've talked about in much depth on the show in the past. Do you have white papers, podcast, blog, anything that we can direct people to keep track of what you're doing?
Yeah, I mean, obviously, a good place to start is either the website or LinkedIn. Because we are a small shop, we don't publish as frequently as some of the large firms out there and so on. But I think the white papers and the sort of, every now and then you see one of the brands that everybody cares about, like a Uber or Peloton or somebody like that, do something big with their pricing, and so we will comment on those. But yeah, I would start on LinkedIn and on our website and go from there. And of course, if anybody's interested in finding out more, just please reach out. There's links to set up a meeting, and the first meeting is always free, and we just love to learn about your business and be of service.
Wonderful. Well, thanks so much for your time, Robert. This has been enlightening, and I appreciate you sharing some of your wisdom on the topic.
Hey, thanks so much for having me, and good luck. I think you're doing a great service to your audience. And I saw, like I said, a number of the topics you had before. And honestly, I'll be watching you and listening to a few more episodes, because there's a lot to learn from all your guests.
I appreciate that. If you talk about enough random things, at some point, I guess you'll hear us recycle some of the same thoughts, but we haven't gotten there yet. We've got a lot of stuff to talk about.
There you go. Absolutely. Well, Grant, it's been a pleasure. Thank you.
Thank you. Until next time.
Cheers. Bye-bye.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.